Today, we're diving into a topic that can have a huge impact on your retirement savings. Should you choose a Roth 401k or a traditional 401k? Now, if you've ever wondered whether you should pay taxes now or later, you're in the right place. We'll weigh the pros and cons to give you a clear understanding of which option fits your financial goals. And make sure you stick around till the end, where I show you a case study of a hypothetical client running different scenarios to see how the different account options impacted their retirement and lifetime wealth. So let's kick things off with the basics. What's the difference between a Roth 401k and a traditional 401k? With a Roth 401k, you're contributing after-tax dollars. This means you pay taxes on the money now, but when you withdraw it in retirement, it's all tax-free. Plus, one big advantage of the Roth 401k is that there are no required minimum distributions during your lifetime. You can let that money grow as long as you want. On the other hand, with a traditional 401k, you're contributing pre-tax dollars. This reduces your taxable income today, which is great if you're looking for some immediate tax relief. But here's the catch. When you start withdrawing that money in retirement, it's taxed as ordinary income. And once you hit RMD age, you're required to start taking distributions, whether you need the money or not. So, which one sounds better to you? Paying taxes now or later? Well, it really depends on your personal situation. Now, let's talk about taxes. Taxes are a big part of this decision. If you choose the traditional 401k, you get an immediate tax benefit. Your contributions reduce your taxable income, which means you're paying less in taxes today. This can be especially helpful if you're in a high tax bracket and looking to lower your current tax bill. But what about the Roth 401k? With the Roth, you don't get that tax break today, but your withdrawals in retirement are completely tax-free. This can be a huge advantage if you expect tax rates to be higher in the future, or if you plan to be in a higher tax bracket when you retire. So here's the question. Do you think taxes are going to be higher or lower when you retire? If you're leaning towards higher, the Roth 401k might be the better choice. If you think your tax rate will drop in retirement, the traditional 401k could be the way to go. But there's more to consider than just today's tax rate versus tomorrow's. You have to consider your income expectations. Your future income is a key factor in this decision. How will your income in retirement compare to what you're earning now? Remember, just because tax rates might be higher in the future doesn't mean your tax rate will be higher. If you're earning a high salary now, remember that when you retire, that salary goes away. Your income sources might just be fixed income and portfolio distributions, putting you in a lower bracket. If you expect a significant drop in taxable income, the traditional 401k could give you more tax savings. But if you'll have multiple income streams keeping you in a high tax bracket in retirement, a Roth 401k might be more advantageous. Let's talk about your retirement goals and legacy planning. Because the choice between Roth and traditional isn't just about taxes, it's about your long-term plans. If flexibility is important to you in retirement, the Roth 401k offers more predictability. Since withdrawals are tax-free, you won't have to worry about fluctuating tax rates eating into your retirement income. This can make budgeting and planning for your retirement lifestyle a lot easier. Now let's consider legacy planning. If you're planning to leave money to your heirs, the Roth 401k has a distinct advantage. Your beneficiaries can inherit the Roth 401k and continue to enjoy tax-free growth and tax-free withdrawals. This can be a powerful tool for passing on wealth without burdening your loved ones with a tax bill. On the other hand, the traditional 401k will eventually be taxed when your heirs start taking distributions. These inherited IRA distributions could push them into a higher tax bracket. So, if leaving a tax-efficient legacy is part of your plan, the Roth 401k might be the better option. And what about your withdrawal strategy? Combining Roth and traditional accounts can give you more control over your taxes in retirement. You can strategically withdraw from your Roth account during high tax years and from your traditional account during low tax years, effectively managing your tax burden. Don't ignore the benefits of having both types of accounts. By diversifying between Roth and traditional 401ks, you can hedge against future tax uncertainties and give yourself more flexibility in retirement. Now, let's talk about how you can take advantage of the tax savings from a traditional 401k to boost your overall assets. So, here's probably the most important piece of this video and an important strategy that often gets overlooked. So listen up. If you're contributing to a Roth 401k, you're paying more in taxes because you're not getting the income deduction. If you're contributing to a traditional 401k, you're saving money on taxes today. So the planning opportunity is to invest the extra tax savings you receive by contributing to the traditional 401k. By investing the money you save on taxes in a Roth IRA or taxable brokerage account, you can significantly boost your retirement assets. This strategy allows you to have the best of both worlds, the immediate tax savings of a traditional 401k and the long-term tax-free growth of a Roth IRA, backdoor Roth IRA, or other investments. Let's take a look at a case study. Today we have Ricky Smith and Rebecca Smith, both age 50. Ricky has a bank account with $80,000 in cash. He has a traditional 401k worth $500,000 that he's maxing out every year, getting a 3% match. He also has $50,000 in a taxable brokerage account. Rebecca has a 401k worth $500,000 that she's also maxing out in a $50,000 taxable brokerage account. They also have a joint brokerage account worth $300,000. They plan to retire at age 67. Their goal is to spend $10,000 per month in retirement plus healthcare costs. They also plan to spend $20,000 each year on travel. Ricky makes $165,000 per year and Rebecca makes $140,000. And like I said, they're both maxing out their traditional 401k with a 3% match. And for this simulation, we're assuming they live to age 90. Now here's their burning question. They're wondering if they should contribute to the Roth 401k option at work or if they should continue to contribute to the traditional 401k. And this is something we can actually model out using our Right Capital software. Like I mentioned, with their current strategy, they're getting a massive tax deduction by maxing out their traditional 401k. With the traditional 401k contributions, their total tax payment for 2024 is only around $75,000. And in this illustration, we're going to assume they will invest every dollar of extra cash flow that they have each year into a taxable brokerage account. So they're taking that additional tax savings and instead of spending it, they're investing it. So by investing in the traditional 401k, they have $29,000 to invest in 2024, $30,000 to invest in 2025, $23,000 to invest in 2026, assuming the TCJA sunset and so on. If they were to max out the Roth 401k instead, their total tax payment for 2024 would be around $93,000, which is $18,000 higher than if they had the tax deduction from the traditional 401k. This means they have less to invest in that taxable account each year. In 2024, they only have around $12,000 to invest, roughly $12,000 in 2025, and only $1,000 in 2026. So how does this reduction in available cash flow to invest impact their retirement and lifetime assets? The traditional 401k has to win since they have so much more additional cash flow to invest, right? It's actually pretty close. In the traditional 401k example, they have a 100% probability of success and $17.69 million in median ending assets. In the Roth 401k example, they have a 100% probability and $17.64 million in median ending assets. There's only a $50,000 difference between these two strategies in favor of the traditional 401k. But wait, here's where the magic happens. Instead of just investing their additional cash flow into a taxable account, what would happen if they took some of those funds and maxed out a backdoor Roth each year? Their total median assets jumps to $18.3 million. That's close to $700,000 more than if they had just invested the additional cash flow in the taxable account alone. So in Ricky and Rebecca's example, the math says possibly go with the traditional 401k, take the tax savings and fund their taxable account, and also do backdoor Roths each year. But there's also other factors to consider that will help them make the best decision for them. But at least at this point, they know the math and can make an educated decision. But of course, this is just a simulation. This is just for illustration purposes only and to open your eyes to different strategies. Please don't assume this means that any of these scenarios are right for you. There's a million different factors to consider and inputs we can adjust when planning for your future. So which option is right for you? The best choice is the one that supports your unique vision for retirement. If you're uncertain about which option to choose, I'm here to help. Visit our website, thehourlyadvisor.com, to schedule a free consultation. Let's work together to tailor a retirement strategy that fits your financial goals and helps you make the most of your 401k options. And if you found this video helpful, don't forget to like and subscribe.